Have you ever wondered why transferring real estate between family members in California have such a dramatic impact on your property taxes? Today we're going to break down everything you need to know about property tax, reassessment, and exemptions for transfers between family members in California. If you're interested in estate planning, tax strategies, and protecting your family's wealth, please hit the like button and subscribe to our channel. Your support helps us continue to provide expert insights on these complex issues. Understanding inheritance laws and taxes in California is crucial if you're a beneficiary of a property. The state's regulations can seem overwhelming, but our goal today is to simplify these concepts for you. We'll cover the basics of inheritance tax in California and what happens if you decide to sell your inherited property, and the various taxes and processes involved. One of the most common questions is there an inheritance tax in California? The answer is no. In California, beneficiaries inheriting assets, whether in cash, real estate, or other forms, are not subject to any state-specific inheritance tax. Additionally, these inherited amounts are not considered taxable income under California's tax. For those who inherited property and later decide to sell it, the primary tax consideration is the capital gains tax. Here, this concept of stepped-up basis comes into play. When property is inherited, its basis is reset to the market value at the time of the previous owner's death. This adjustment can significantly reduce the taxable gain if the property's market value has increased since the original purchase. However, if you sell the property at a profit beyond stepped-up basis, and after deducting any eligible expenses like improvements or sales costs, capital gains tax will apply. It's important to note that most inherited real estate in California must go through probate, which is the legal process that authenticates a will and facilitates the distribution of assets. Probate typically involves settling any outstanding debts and paying property taxes and handling other expenses such as mortgage payoffs. In cases where the property is mortgaged, clauses like the alienation clause or due on sale clause might be activated, requiring the inheritor to repay the full mortgage amount upon transfer. There are ways to bypass or simplify the probate process in California. For instance, using a California transfer on death TOD deed allows property owners to transfer ownership directly to a designated beneficiary upon their death, avoiding probate entirely. Additionally, if the property was held in a trust, the transfer to the beneficiary can occur without the lengthy probate process, ensuring a smoother transaction. While California doesn't impose an inheritance tax, there are other taxes to be aware of when selling inherited property. Capital gains tax. This tax is applied to any profit made from the sale of the property. The taxable gain is calculated as the difference between the selling price and the property's stepped-up basis, which is its market value at the time of the decedent's passing. Expenses related to improvements and the sale, such as realtor fees and closing costs, can be deducted from the gain. Taxes on inherited property transfer tax. When ownership is transferred, local governments may charge a one-time transfer fee. This fee is usually a small percentage of the property sale price. Property tax. In California, the assessed value for property tax purposes is generally based on the acquisition cost of the property. Over time, this value is adjusted for inflation. However, if a property is reassessed during transfer between siblings, the new assessed value will be based on the current market price, potentially leading to higher annual taxes. Understanding these tax implications is critical when planning to sell an inherited property, as they can significantly affect your net proceeds. Capital gains tax can be a major concern for beneficiaries looking to sell inherited property. Here are the several strategies to help minimize this tax burden. Convert the inherited property into a primary residence. By making the inherited property your primary residence for at least 2 years, you may qualify for significant tax exclusions under IRS rules. This can substantially reduce or even eliminate your capital gains taxes liability when you sell. Use the property as an investment. Converting the property into a rental and utilizing a 1031 exchange to acquire another investment property can help defer capital gains taxes. This approach is ideal if you're interested in growing your real estate portfolio. Sell immediately. In cases where the sale price is close to the stepped-up basis, selling the property quickly might result in little to no capital gains tax. This strategy requires careful market evaluation and timing. Disclaim the inheritance. Although it's a drastic measure, disclaiming an inheritance can help avoid the tax complications altogether if you do not wish to assume the tax burden. However, this decision is irreversible and should be considered only after thorough consultation with a tax advisor. If you are a California resident inheriting property from a non-California resident, the tax landscape can be even more complex. Inheritance tax implications depend on the laws of the state where the property is located. For example, states like Iowa, Kentucky, Nebraska, Pennsylvania, Maryland, and New Jersey impose inheritance taxes. Typically, if the deceased spouse is the beneficiary, the transfer is exempt. However, for other heirs, you might be required to pay taxes according to that state's rates. It is essential to understand the specific tax regulations of the state in question to manage your inheritance effectively. Proposition 19 has brought significant changes to the way property taxes are handled for inherited real estate. Under Proposition 19, property tax reassessment. When a property is transferred from parents to children or from grandparents to grandchildren, it is generally exempt for reassessment, as long as the heir uses the property as their primary residence and the increase in assessed value does not exceed a set threshold, typically $1 million above the original value. Changes from previous rules. Previous parents could transfer their primary residence up to $1 million of additional value to their children without triggering a reassessment. Proposition 19 has narrowed this exemption, meaning that in many cases the property will be reassessed at its current market value unless the conditions are met. For families, this means careful planning is required. If you're inheriting property from a parent or grandparents and plan to make it your primary residence, you may be able to preserve the lower tax basis. However, if you inherited property and do not use it as your primary residence, the property may not reassess, leading to higher property taxes. What happens if siblings are facing a situation where direct transfer would trigger a reassessment and lead to an unaffordable property tax? One innovative solution is to use a third-party loan to facilitate a buyout of one sibling's share. Here's how it works. When a sibling uses a third-party loan, often provided by companies like HCS Equity, to buy out others' shares, the loan is secured by the irrevocable trust or estate. Structuring the transaction in this manner can recharacterize the transfer of a parent-to-child transfer. This reclassification allows the transaction to qualify for the tax relief under Proposition 19 or earlier under Proposition 58 or 193, thereby preserving the original tax basis. This strategy is particularly useful when one sibling cannot afford the increased taxes that come with a full reassessment. By obtaining a private loan to buy out the other sibling's interest, the transaction is structured in a way that can maintain the lower inherited tax basis. This approach not only minimizes tax burdens, but also helps keep the family property intact. If you're in a situation where a sibling buyout is being considered, here are some tips to ensure a smooth transaction. Open communication. Begin with transparent discussions about each sibling's financial circumstances, long-term goals, and emotional attachment to the property. Clear communication is essential for reaching a mutually beneficial agreement. Consider mediation. If reaching an agreement is challenging, consider hiring a professional mediator. A neutral third party can help facilitate constructive discussions and resolve conflicts effectively. Consult with professionals. Work with a qualified attorney and a tax advisor who specializes in probate and real estate transactions. They can help structure the buyout properly and ensure that all legal and tax implications are fully addressed. In addition, consulting with a private lender can provide you with options for obtaining a third-party loan that fits your needs. Document every step. Keep detailed records or negotiations, agreements, and financial transactions related to the buyout. This document is critical to prevent disputes and to provide transparencies for all parties involved. Evaluate the financials. Careful analysis whether the benefits of preserving the tax basis outweighs the cost of obtaining the loan, including any fees and interest charges. A comprehensive financial review will help you determine if the buyout strategy makes sense for your family. Navigating the tax implications of inherited property is not just a one-time decision. It's part of a long-term family planning. Here are a few long-term considerations to keep in mind. Comprehensive estate planning. Work with your legal and financial advisor to ensure that your estate plan clearly outlines how property should be transferred. This includes drafting or updating wills, establishing trusts, and setting up mechanisms to avoid probate wherever possible, such as using a TOD deed. Regular reviews. Laws and market conditions change over time. Regularly review your estate plan and tax strategies with your advisors to ensure that your plans remain aligned and with current regulations and economic realities. Family communication. Maintain open lines of communication among family members about your shared assets. Regular family meetings can help ensure everyone understands the plan and reduce the risk of disputes when it's time to transfer property. Contingency planning. Prepare for unforeseen circumstances by establishing contingency funds or backup plans. This proactive approach can help manage unexpected expenses and ensure that the property remains within the family while preserving its tax advantages. By planning ahead and communicating openly, you can navigate these complexities, make decisions that not only protect your financial interests, but also preserves your family's legacy for future generations. To illustrate these strategic actions, let's look at the Smith family. The Smith family siblings inherited a family home from their parents, a home that held deep sentimental value. However, a direct transfer between the siblings would have triggered a reassessment at the current market value, leading to unaffordable property taxes. Facing this challenge, Their realtor proposed a creative solution using a third-party loan to buy out the other siblings' share. With the assistance of a seasoned attorney and a knowledgeable tax advisor, the Smith family structured the transaction so that it was reclassified as a parent-to-child, transferred under California law. They were able to preserve that and work within the Proposition 19. This was a winning scenario, winning the home without facing a steep tax hike, while the other siblings received their fair compensation for their shares. The Smiths family experience underscores the importance of innovative thinking and professional guidance when navigating complex inheritance and tax issues. Handling taxes on inherited property in California can be a daunting task, but you don't have to navigate it alone. Consulting with a CPA or an attorney who specializes in estate planning and real estate law is crucial to ensure you're making informed decisions. These professionals stay up to date with the latest tax laws, including the intricacies of Proposition 19, and can provide personalized strategies tailored to your unique situation. Whether you're inheriting property from a California resident or from a non-resident and facing different tax rules, the right professional guidance will help you minimize tax liabilities and protect your family's legacy. Don't hesitate to reach out to experts who have experience and knowledge to guide you through every step of the process. Navigating property tax reassessment and understanding the exemptions available for transfers between family members in California is complex but crucial. Whether you're inheriting property, planning a sale, or considering a sibling buyout to avoid a tax reassessment, being informed and proactive is your best defense against unexpected tax burdens. Take the time to consult with professionals, plan your estate carefully, and keep open lines of communication among family members with the right strategy in place. You can protect the property's original tax basis, minimizing your tax liability and preserving your family's legacy for future generations. If you found this video helpful, please subscribe to our channel and click the notification bell for more updates on estate planning, real estate, and tax strategies in California. Share your questions or experiences in the comments below. Your input helps us create content that truly serves our community. The information is intended for information purposes only and is not intended as tax or legal advice. Please consult with counsel before taking any steps in reliance on any information contained herein.